Okay, so welcome back to the Princeton Lectures in Finance. Arvind Krishnamurthy will give us now a domestic international safe asset perspective, and we're looking forward to it. Thanks again, Arvind.
Okay, thanks, Marcus. So what I'm going to talk about today is talk through a couple different papers I have. By the way, I should thank all of my co-authors whose work I will be referring to as I go through this. And if you want, I think the broad theme that I'm going to talk about is that there are liquidity services convenience yields on safe debt, both of private debt as well as public debt. Okay, that's a good way to think about the world. It is a way that helps you understand some asset pricing, which I'll start with, some corporate finance banking, and then I chose to spend more of my time talking about international, kind of along the lines of what we talked about yesterday, and so that's where I'm going to flesh this out. I think the idea of thinking about the world economy as a whole, in part producing safe assets, gives me a nice way of thinking about how the international financial system sits together. Okay, so that's basically what I want to talk through. I know some of you know this work, and I apologize if I'm going to bore you on it. I know there's also a lot of PhD students here, so you should feel free to jump in and ask me questions. Okay. So I'm going to walk through four things. I want to start by talking really about my work with the net. Tell you how I think about that. And then on point two, I'm actually not going to talk about my own work, but I feel like it's a very important question. The thing that we see in the world is when we say convenience yields attach themselves to safe assets, there's like why is it they attach themselves to safe assets? And safe assets often mean debt. Why is that important? It's a very basic question that needs to be sorted out. And for myself, the way I've understood the world is really these papers for me are what settle why it's about debt in the world. And debt is very important because the other side of debt is, of course, is leverage. So understanding why convenience yields attach themselves to safe debt is actually very important for thinking about macro impacts of these types of issues. So I want to spend some time about that. And I'm going to talk about some work I have been doing with Zheng Yang and Hanno, which is then thinking about, from a positive standpoint, how to understand the international financial system through the lens of public and private safe assets. And then last, I'm going to be somewhat speculative and spend a little bit of time talking about how I think about the breakup of Bretton Woods. Okay? And we don't have a paper, but we're thinking about this, and so I also wanted to talk about that. Right, so I'm going to start here. I think this is a picture that I bet many of you have seen before. This is from my paper with Annette. The y-axis is long-term AAAs, corporates versus treasuries. So it's a corporate bond spread. And the x-axis is the total supply of government debt normalized by GDP. And if you're in finance, you know that if you look at something like a corporate treasury spread, your first inclination is, oh, I know that that spread should include something having to do with corporate default risk. And there's a long-standing literature that understands that treasuries are more liquid than corporate bonds, so there should be some component of it that also has to do with the liquidity premium. And I'd say, the state of the literature in 2010 was we understand that the spread has, from an asset pricing standpoint, default risk plus some liquidity. And I'd say broadly the way people thought about liquidity there was at a microstructure level in terms of transaction costs, how easy it is to trade treasuries, and treasuries versus corporates were sort of looked at in isolation. If you want, our contribution to this was to think about that liquidity piece and recognize that it depends upon the total supply, the total quantity of liquid assets, which in this picture is something having to do with the total quantity of government debt. So in that sense, we were trying to draw an analogy between the liquidity services of treasuries and money. And this looks basically like a money demand function. What I felt I learned from this was that one shouldn't think of that corporate treasury spread in isolation. It's not a microstructure thing about treasuries. In fact, it tells you something broadly about the way treasuries are used. They're used more broadly in portfolios to satisfy liquidity needs of a collection of investors. And the liquidity needs are more satisfied if there's a larger quantity of liquid assets. And when there's less, then you would expect these liquidity spreads to be high. Yeah.
I mean, I was thinking of exactly this yesterday.
Yeah.
You don't have, yesterday is the opposite sign, no?
Yeah, so it's a great question. The paper yesterday has two pieces in it, one piece which I didn't get to. The way to think about it is within, you're picking across equilibria. More debt pushes you to a better equilibria. If you sort of stick within an equilibrium, you can get the downward sloping convenience yield effect. And it's in the paper, but I didn't talk about it in the talk yesterday.
This is about the G that you were fixing yesterday.
Yeah, so more G moves you into there's another effect that kicks in. So I think the way the model I had written down yesterday, particularly with the theta equals 1 case, the case in which the matching technology has just the multiplicative property, will always get you a feature that more debt increases your convenience yield. As soon as you go to a case in which theta is a little less than 1, what you'll find is that more debt can create entry, but will also decrease your convenience yield. And what that then does is it means you'll get entry of borrowers who are in there for the settlement benefits of the liquidity, but not entry of borrowers who are there to exploit the convenience yield. That's the full answer to what happens in that paper. And if you ask me, that's sort of the right parameterization. The right parameterization is one in which more debt reduces convenience yields, but still makes it attractive for people to enter, firms to enter, because they value the settlement benefits. OK, so this is how I think about this. If I step back and ask, what is it about treasuries that are valued? I think that the thing about treasuries is, at the end of the day, it's really about short-term treasuries, which are money. There's needs for investors to hold short-term safe assets, and it shows up in a collection of places for liquidity purposes, transaction purposes. Historically, it was probably just mostly payment purposes, like along the lines of what I was discussing yesterday. In the world today, we know that treasuries, for example, act as collateral to allow a collection of financial transactions to happen, and that if you didn't have treasuries, it would be harder for this to happen. What's essential about it is to have an asset that you can pledge as collateral or that you can use, which everyone knows their value, and its value really will not change. That is a property at heart that I think is true of short-term safe treasuries. So then you might ask, well, where does long-term treasuries fit in? And in fact, this picture here is a long-term treasury spread. It's not a short-term treasury spread. It's roughly 20-year AAAs versus treasuries. What I think is happening in that picture is long-term treasuries in the world are collateral. They're very good collateral. The financial sector is set up to allow you to take collateral like long-term treasuries and convert them into short-term treasuries via the repo market. And it's the repo that's money. So the way really I think about that long-term spread is the long-term convenience yield is the collateral value in being able to convert long-term stuff into short-term stuff. Long-term treasuries also have some unique value in investor portfolios. There's certainly some investors who need it for portfolio reasons, but my read on the data, and I will say more about this in the next slide as well, is that actually most of the convenience yield comes from the short-term treasuries and the fact that the long-term stuff can be used to create short-term. Okay. Okay. So here's a way of seeing that.
So to rationalize the picture,
yeah,
cannot be true of the AAA corporate.
It has to be less true of the AAA corporate. That's exactly right.
What, maturity or risk, or what would it be?
I mean, in the case of the long-term AAA corporate, I would say long-term AAA corporates are largely not available in the repo market. Why would they not be available in the repo market? From a transaction purposes, they're far less liquid. There is this, the advantage of Treasuries in a sense is we know exactly what the value is. I don't really need to investigate Ford's credit versus GM's credit, which in the corporate credit market you have to. So if you think, oh, I'm going to lend repo against Ford corporate bonds, I need to know a little bit more about that default risk, whereas Treasuries are free of much of that. So it doesn't show up so much in the repo market, so I think it probably doesn't have so much of the collateral value that I assign to it. I think there is some evidence that we provide in our paper that even AAAs have some kind of special service value, which actually, in my mind, it connects to these types of things. There are portfolios in the world that want long-term, relatively safe assets. They could get it via Treasuries, but you've got to pay a big premium, and Treasuries are being used more for converting into short-term stuff. So it's the AAAs that end up showing up in insurance company and pension fund portfolios, right? OK, and so then again, just to clarify, the long-term yield really reflects the expected convenience yield. The expected short-term, you can almost think of it like an expectations hypothesis thing. That's how I think about that spread. Let me do another side of this. So actually, Ricardo, what you just asked is very relevant to this. I'm thinking now, the long-term AAAs have some convenience value as well. But there's a larger convenience value attached to private assets that are safe debt. And you can see this in the following way, which is this is the regression version of that picture I showed you. If you replace the AAA Treasury spread with the spread between P2 rated commercial paper and P1 rated commercial paper, P1 rated commercial paper is equivalent of AAA very short-term corporate debt. P2 rated commercial paper is a slightly more risky version of that. So one of these is much, much safer. And if it is the case that investors as a whole value short-term safe assets, and there's less Treasuries outstanding, then one would expect that the convenience yield you attach to private assets, which were substitutes for the Treasuries, would also rise. And that's basically what this regression tells you. So you can look at asset prices, and this is the same thing. That's commercial paper. These are bank deposit rates, right? So flip out. I have no Treasuries here. P2 rated commercial paper and bank deposit rates. The way I think about this is that's the regression which we're estimating. There's a convenience yield in whole. There's some loading for a given asset, and what I'm picking out here is that exposure. Okay, so that tells me that actually there's a commonality between private short-term debt and Treasuries, and this is also, and I'm looking particularly at deposits and P1 commercial paper, short-term private debt. So that is also why I think, with respect to the previous argument, that it's the long-term Treasury. The Treasuries are valuable because they're short-term, or you can convert long-term to short-term. And that is what, and in the private sector, they're doing that directly. Capital structure decisions of banks and firms are throwing out short-term debt. And that short-term debt has high value if you can deliver it. And from a corporate financing standpoint, it's a way of thinking about why it is that very large firms very often issue lots of short-term debt. Well, it turns out people attach value to it, and why banks are levered the way they are. Okay, that's a fact about prices. Yeah.
Can you interpret the size of the coefficient, because the deposit is 3 times as large?
I mean, it tells you something about the convenience value of deposits. Right? It's very high. Some of you probably are already thinking, and it sort of follows from what you're saying, this already tells you actually that the regression I should have been running should not have been debt here. It should have been an aggregator over different, which let's talk about that next, right? So this tells me right away that there's a bunch of assets that are offering service value, that have some commonality to them. Apparently, with bank deposits, there's a particularly high value attached to them. So that then tells you that there's some common component. Bank deposits are used for transaction purposes. So treasuries must in some way be used for transaction purposes, maybe less so than bank deposits. And then maybe commercial paper is more like treasuries, given that coefficient. But there's formal ways we can do this, which I'll just outline a little bit. Right, so that's prices. You can also look at this from in terms of quantities. So you would expect that if you say reduce treasury supply, I just showed you that increases convenience yields on private debt, you would expect that the private sector would respond to that by increasing the quantity of private sector assets. Okay, this is another picture from one of my papers with the net. It's basically the same variation, but now I'm replacing this, the price, the spread thing with the quantity of total short-term bank debt. That fits very nicely over low frequencies. There's a nice paper by Greenwood-Hansenstein which basically looks at the same type of thing, and there's an issue with this empirically because there's no instrument here. They use an instrument that I think nails this a little bit better. But the prices and quantities tell a fairly consistent story, which is that broadly speaking, the economy is generating debt, private and public debt, that have some commonalities that are valued by investors. So the regression I started out with was putting the AAA Treasury spread and then against the quantity of debt, and I was saying, oh, look, I'm estimating something like a convenience yield. The way really one should think of this is that there's actually some quantity of convenience assets that aggregate public and private, like a kind of money demand aggregator. We should put this stuff together. And really, in that regression, what we're doing is what we should have been doing is running this regression with that total quantity and then, say, instrumenting with debt to GDP. That's the way I interpret that previous regression. So then there's a whole bunch of interesting questions that pop up, and this is related, Marcus, to your question, which is how close should one think that public debt, treasuries, and private debt, how substitutable are they? Do they offer the same types of convenience services, don't they? And so there's been some work on that. Stefan Nagel has a nice paper looking exactly at this question about substitutability between treasuries and bank debt, working with a CES aggregator. He comes away from his regression saying that these things are actually perfect substitutes. I have a paper with Wenhao Li who looks at the same question, and actually we come away thinking they're imperfect substitutes. So there's open questions here about exactly how to construct an aggregator. They're important questions both in informing us about the asset pricing and also informing us about what types of debt will, say, respond if the quantity of treasuries are less, right? So that's how I see some of this stuff. Okay, let me talk about this debt question. So I think of long-term treasuries as having convenience yield really because they are collateral in the repo market. And the asset that really has value is the repo. To some extent, the fact that there's a convenience yield attaching itself to a bunch of public and private assets, and when you add up the number of public and private assets, it's a large number, right? I add up total quantity of treasuries, add up bank debt, add up commercial paper. We're talking about numbers for, in the last 20 years into the 10, 20 trillion. So apparently, the world really wants liquid assets. They want assets. So the problem of the world at some level is generating enough assets to use for all of its purposes. And then you ask, well, what's the difficulty? We have plenty of assets. We have stocks. We have real estate. We have lots of assets. Why can't we use all of those assets? And you have to think then that it's not assets per se. It's particular assets that we really want. Right? The world doesn't want just we don't want the S&P 500. We want a particular way of carving up the S&P 500. And the fact that all of these convenience yields attach themselves to debt almost tells you, yeah, what does the world really want? It wants debt. And so this is the debt hockey stick, which will be familiar to everyone. I'm plotting here underlying collateral value against debt payoff. And choosing the face value on debt, if you move it to the right, you're creating more value out of the same collateral. Right? The equity contract gets maximum value. Set the face value to infinity, and you've pledged all of the cash flows. That maximizes the total amount, the way in which you can convert an asset into tradable value. But that's not what the world does. The world takes assets and puts a face value that's relatively low relative to the underlying asset value, so that in most states of the world, the payoff is insensitive to the underlying asset value. You can think of what corporate finance is doing, and this is basically what the repo market's doing, is it's taking underlying assets, choosing a face value such that we can make sure that that debt has a value that's constant in as many states of the world as possible. And the trade-off is if you make it very little, if you make the face value very small, you aren't creating many assets, but you're for sure going to be very safe. So there's somewhere in the middle that we've settled on what matters. And so why is that important? I think at heart it's these ideas that Gorton Panaki, DeMarzo Duffy, and Dan Gorton Holmstrom have been emphasizing, which is about information sensitivity. We trade assets. If I know nothing about underlying asset value payoffs, it's very convenient if the security I'm trading doesn't depend upon what I don't know. I don't know whether the value is here or here. The beauty of the debt payoff is it just cuts information sensitivity at all away and just loads it up into these states. And so, for example, Dan Gorton, Holmstrom, Gary Gorton argue, well, when we fall into these states, that's the crisis. Most of the time we're out here and we're fine. We've created the debt we really want, but there's always a problem that we could put ourselves into this position. Yes?
Do you have a take on the real value of all of this stuff of repo transactions and data? So for example,
Like, what is it used for?
What is it used for? So I could have a cynical view, which is to say this is just used for speculation and
I don't think it would be used for. I think, to me, GameStop is used for speculation. Like, you don't use debt for speculation.
No, I mean the like.
We're passing debt.
So what is it used for? What's the real value? That's another way to frame the question. What's the real value that is getting added because of the ability to do these repo transactions?
Okay, so first of all, it's a very good question, and I don't have a full answer to it. It is, and I'll just give you some thoughts on this. I take the fact that we're mostly using debt, okay, and that we've constructed debt to be very safe, as being that the world wants to trade an asset where they don't know anything. That's why this doesn't feel like speculation. This feels like you and I need to do a transaction for some other purpose. The old money model was you and I need to buy and sell a good, and I need to pass you something that we both agree the value on. And debt, very safe debt, has exactly that property. So that, to me, is a leading reason for why this is necessary.
But let me just explain the speculation. I didn't mean speculate, but I meant you can basically increase your leverage.
Yes.
With these, if you have this kind of debt versus, let's say, corporate debt, which
Yeah.
is why it then gets a convenience yield. But what you're really using it for is effectively to increase the net leverage in your portfolio, and
Yes.
you're using that for speculative purposes.
I'm with you on all of that. Okay. Now, in the world, if you look, for example, at repo markets, the biggest asset that's being pledged in the repo market is long-term treasuries. Do you really think that everybody is speculating on where long-term interest rates are going? I find the speculative argument very attractive for thinking about equities or, risk securities. But that's not the stuff that, for the most part, is levered up. It's certainly, there is some leverage there. But if you collect the $10–15 trillion of, to me, it's somewhere else. Now, I do think it's the case that the very fact that if you can produce an asset that's very safe and that attaches itself to convenience yield, you can do something with it. That's a way of thinking about banks. And then it turns out, if you can do that, then make loans. And so there's a speculative dimension that creeps in. But I would sort of run it from the other side. than purely speculative motives, right? So then back to your question, what is it used for? I don't have a clear answer. I gave you a model yesterday in which there was a need for an asset for liquidity purposes, and it was actually internally generated, right? The firms in that model issued debt, borrowed, and then they needed to buy another asset to make repayment. So that was financially generated liquidity needs, which, for example, is very different than if you think about, say, a cash and advance model, sort of a goods transaction model in which we're using assets to buy goods. So I liked what we were doing yesterday because it feels more true that we use these assets, we buy and trade assets for financial reasons. Just to give you another data point, if you go look at Fedwire flows, you know that the bulk of payments running through the Fedwire does not tie itself to goods and service transactions. They are mostly financial transactions. I don't fully understand why, but it turns out to run an economy, we need to pass assets around so many times to do what we need to. That way of thinking about repaying debt is like a piece of it, but it must be much more than that. I don't think I have anything deeper to say about it, but of course it seems like quite an important set of questions, and at this point it feels to me like an open question that needs to be answered. Just to finish on this point, I think this is also why stocks aren't money, right? You could say, well, you could argue, well, stocks, why don't we use stocks to, we have the S&P 500, we know the value. The advantage of debt is you don't need to know anything. You and I can trade debt without knowing anything about the value. You can say, should be able to observe the S&P 500 price, so why don't I trade that? And the answer is, yeah, we can observe it, but any smidgen of asymmetric information will show up and affect trading. It would be better to take that same S&P 500, convert it into the debt claim, and we trade the debt claim because we've just taken away all information out there.
I mean, that's a little tricky because
Yep.
I'm not sure that you may know better where the kink is.
Yes. Yeah, exactly. We're sort of, broadly, we look at the world and we say, we're probably here. So it's at the end of the day, it's somehow minimizing where the security design problem is basically trying to create as much convenience assets as possible while minimizing states of the world in which there might be lemons problems that impede trade. Okay, as I said, this is not what I've worked on, but I actually think it's a really important set of things to understand how the world sits. I talked about this yesterday. I thought it was just a very nice example of this money creation. What the Bank of Amsterdam's quantity at the bank really grows in this period. This is this gray line. That's the quantity when it really grows. What's happening there? The bank introduces a facility in which you bring the bank coin, and the bank will give you a florin deposit. You and the bank may not agree on the value of the coin that you're bringing the bank. The bank will just give you florin less than the value of the collateral. And you might think it's worth 90, and I might think it's worth 95. I'll just give you some minimum value. And then the bank will then sell you an option to reverse the transaction. So we don't have to agree on the value, but you've now created florin. Now, the repo is just this remarkable technology which allows you to convert assets which you don't know the value of into the thing that we do know the value of, which is the florin technology. And that's really when the assets swell. It's also when the assets disappear. The Bank of Amsterdam goes belly up right around here. This is when another thing happens, which is the bank starts acting like a questionable bank. This part here is loans. These are loans to the Dutch East India Company, which then starts defaulting on their loans. And then the city is now in a war with France, and it says, boy, I've got some gold here, maybe I can get it. And so that loses assets. But you also notice that investors suddenly exercise their repo option. They go back and take the coin away, and which is why the quantity falls quite well. But over a long period of time, this was a pretty successful bank. in generating assets the rest of the world could use. Okay, so I can take these ideas and we can kind of go in different directions. One direction one could go with is Annette and I have done work on QE, which I think of about as shifting stocks of assets that have convenience value. I've already mentioned this. You can think about the question about banking through the lens of debt creation. I'm going to just carry on with what I talked about yesterday and talk instead just about international finance. Okay. And there's basically, I think, two things I want to try to highlight here. So the work on treasuries, to me, convinces me that a sure promise of $1 at T+1 has a high price today. Okay? That is especially true of US treasuries. It's a sure promise. It has a high value. It's also true of very safe corporate debt promises. I'm going to try to show you two more things, which is, I think, what's interesting internationally. I have a feeling, and I haven't done this, but I suspect it's true, that that same thing would be true within the UK economy. That very safe debt promises would attach themselves to UK T-bills, and they probably would have a convenience yield. And I bet that's true of every country in the world, that there's a stock of safe assets, and they have high convenience value. For the international financial system, I think the interesting question to ask is, which asset has the highest value? In a sense, the way to interpret the stuff I've shown you in the US is, domestically we need to do all these transactions, and so it turns out safe debt is a way of doing all these transactions, and so convenience value gets attached to safe debt assets. And I suspect that's true of every economy in the world. The international question is, there's transactions that need to go across border. And so which assets do we use there? And that tells you something about the way the international financial system is structured. And so I'm going to show you two things. The first thing I'm going to show you is that a sure promise to pay $1 at T+1 has a higher price than the promise to pay a pound. Okay? So if you kind of take all of the safe assets of the world in different currencies and you ask which one has the highest value, it's the dollar claim. That's the thing that has the attaches itself to the highest value. And in a way, that's like another way of saying it's some version of something about a reserve currency. I know, Jonathan, you have this paper recently which talks about the flip and sign in some of these things between UK bonds and US bonds. So that I'm going to show you some data that suggests that for the last 25 years, it's the US claim that has the highest global value. That's not to say that other claims don't have value. It's the highest claim is attached to itself, the US assets. The other thing I'm going to show you is that foreign investors, in particular, relative to domestic investors, place higher value on the promises to pay the dollar relative to US investors. So that wedge, if you want, grows at some times relative to other times. So there's variation in how these wedges show up, and they move around over time. So I'm going to show this to you through another set of spreads. And so let me just start by explaining what I'm showing you. This is what the international literature has called the treasury basis. I think it was first constructed by Wenshin Du and Jesse Schrager. And it's a very simple spread construction. It's construct the spread between the US Treasury yield and a one-year foreign government. And when I say foreign government here, this spread is constructed as an average across G10 foreign governments. Swap that using an FX forward back into dollars. Okay, so for the sake of explaining this, think of taking the one-year UK government bond, putting an FX swap on it to convert it back into dollars, and constructing that spread relative to a US Treasury. Okay, that's the red line here. And the red line being negative is basically a statement that the US Treasury yield on the swap basis is much lower than the UK government bond yield. Okay, if you just look at that spread, you could say, oh, fine, I understand that. It's the US government bond is a more liquid bond, and maybe liquidity premium move over time, and that's what's explaining what's happening in this spread. There's another fact, though, that emerges from the data, which is that if you look at movements in the bilateral dollar, and the bilateral dollar here is measured relative to the same underlying government bonds that I'm constructing that spread, there's a very strong relationship between movements in the dollar and movements in the spread. In particular, in the data, if the spread goes down, the dollar appreciates. So the data tell us that there's something in the world that looks like I value treasuries and I value dollars. All right, those two prices move hand in hand. So, and you know, if you can look at these R-squares, these are quarterly data regressions. They're quite high for explaining exchange rate movements, given what we know about, or how little we know about exchange rate movements. And this only works for the dollar. If you drop the dollar from the sample, these basis things have little to do with exchange rates. So this is a fact about the dollar, about a particular set of spreads co-moving with the dollar. All right. So what I'm gonna take you through is I read this co-movement in particular as saying something about the value attached to dollar payoffs. One could have looked at this and said, hey, this basis is moving around. So sometimes people like treasuries, sometimes people like UK government bonds, and that's its own thing, just two assets. The fact that the exchange rate's moving tells me it's something not just about treasuries, it's something about dollar assets. And I'm going to try to run you through the fact that these two things move together to extract out the value that investors in the world are attaching themselves to dollar assets and not just to treasuries. Okay. So here's how we're going to do this. So I think the way I want to interpret that spread I just constructed is the treasury yield. Think of it as the interest rate on some benchmark no convenience yield asset minus something like a convenience yield. The government bond swap to dollars, think of it as the interest rate on a no convenience yield asset minus some fraction of the convenience yield. Okay. In particular, I just want to say that the way I've written this, it's a little bit like the way I wrote some of the equations before. The foreign government bond, it's sort of good, but it's just not as good. Right? It's sort of a decent dollar asset. What you've done is you've taken a UK government bond, swapped it into dollars, and you've created a sort of pseudo treasury. It's not as good as the real thing. Why is it not as good as the real thing? Well, it turns out because you have a forward in there, for example, that you need to care about. And with the forward, you've got counterparty risk. You've got to worry about the bank who's written the forward. So it's a synthetically created thing, which is not as good as the real thing. Okay? So that, for me, is a motivation for why beta I is less than 1. Okay, if beta I is less than 1, then I can say that basis, that construction I just measured, is the convenience yield times 1 minus beta I. Okay. So then let's do a little bit of asset pricing with this. I'm going to think of a world in which there are two countries, dollar and foreign. S is the exchange rate. I've written it as foreign per dollar, just for me, who doesn't always do international. That means S goes up, means dollar appreciates. I know we usually do it the other way around, but I like this way better. There's two government bonds. The dollar one offers convenience utility. The foreign one doesn't. Okay, I'm just going to assume that that's true. And these are interest rates or bond yields. I can write down an Euler equation for a foreign bond foreign investor who's thinking of buying the foreign bond or the dollar bond. This is just a first order condition. Almost nothing needs to be assumed here. And then you get an expression that looks just like a UIP condition, right? Expected exchange rate appreciation, interest rate differential. We're doing things in logs, so there's a Jensen's term that you have to deal with. But what I'm really interested in is what's on the right-hand side. This is standard UIP, where you say that whatever compensation or exchange rates is a risk premium. But now I'm going to say, but one of these assets is the dollar treasury bond. So for the dollar treasury bond, we should put a wedge in there. When I construct the UIP relation, I should add in the fact that an investor abroad who's thinking, say, of buying UK government bonds or US Treasury bonds, and under my assumption, puts some special value in the US Treasury bond, will say, I'm willing to accept a lower return on buying the US Treasury bond than the foreign government bond. Okay, so that has to mean that there's a wedge in here. Okay, so then you can immediately start to see where I'm going to go with this. If this thing is moving around over time, and this guy moves up, like I value the U.S. government bond more than the foreign one, something on the left-hand side has to adjust. I need to move something on this side. Okay. I'll explain this in a second, but what I'm going to assume is that those interest rates are not going to move. Okay, we can make them move a little bit, but let's for the sake of argument pretend that those interest rates don't move. For example, they're set by monetary policy. Then what has to happen is the exchange rate has to change. Okay, so that's the data fact, which is the movement in the basis is moving the exchange rate, actually informs me about something having to do with the way in which lambda star, the willingness to buy dollar assets, is showing up in exchange rates. Okay, so to fill out the steps, let me assume that there's a U.S. investor. He has some discount factor. Maybe he also values U.S. Treasury bonds particularly. Called rho the no convenience yield interest rate. It's the expected SDF, log SDF, minus whatever convenience yield he attaches to treasuries. Just plug this guy into there. Now you get a UIP equation. I'm just going to show you this for a second, actually, but I'm mainly going to work with this because you'll see that what really matters for what you have to say about the change in exchange rates is the difference between the convenience yields between foreign and US. And that's that second fact I told you. What I'm going to tell you in the data is that there are times in which the foreign investor really values the treasury. That's the time in which the dollar appreciates. That's sort of what I need to get dollar appreciation with treasury basis going more negative. Yeah.
I mean, because you also think that the risk premium can move in that period. Why don't you just work with CIP and the forward premium or discount?
Yeah, so I am going to work with CIP. But I think to understand exchange rate movements, I have to work with UIP. CIP doesn't tell me anything about exchange rate movements. It's just at the level of spreads.
It tells you about it'll tell you about the spot versus the forward, right?
It'll tell me about the spot versus the forward.
It tells you the spot versus my expected future exchange rate. It's the same.
So again, I'm going to interpret this equation as saying if I'm in a state which lambda star goes up, holding fixed tomorrow's exchange rate, today's exchange rate has to appreciate. That's the data fact that is present in the world. I can't, if I just played with CIP, I couldn't do anything.
You could hold the fix the forward rate.
I could hold fix the, but I wouldn't.
We don't see the expected.
We don't see that expected. So this is the fact that there's that contemporaneous relation. As long as exchange rates eventually come back, okay, so another way of saying this is, so here's what I'm going to do. You can take this equation. It's I mean to make almost no assumptions to write this equation down. Right? This is just an Euler equation for a foreign investor. Take that equation and just iterate on that, and you get what looks like an asset pricing equation. I'm going to flip to real because I need to make some stationarity assumptions to make this equation make sense. So flip to real, assume that the exchange rate is stationary, and then what you have is something that looks fairly standard. This is future interest rate differentials. There are risk premium, but now you see I have this other term in here, right? And so this is what I'm interested in. The data tell me that when these bases are moving, that exchange rates are moving. And so I want to interpret it through the lens of this equation. Okay. All right, so here's the next step, which is, and this is, I think, I don't know if this is where you're going to go, but this is where we want to go. We're going to now, the problem in the world is I actually don't know what the convenience yield is. I don't know what lambda is. And this is a fine equation, but I don't know what these lambdas are. But I can use the basis to tell me the lambda, because the way I'm interpreting the world is that the treasury and the foreign government swapped into treasuries both have some convenience value attached to them. They have different amounts of convenience attached to them. And the differential should give me a relation between the basis and the convenience yield. So I'll take that fact, use that equation, rewrite it, substitute the thing I don't know, which is lambda, into the thing I do know, which is x. I can measure that, and then take this equation and estimate this equation. And estimate this equation, what I mean by that is control for stuff here and try to extract what beta I is. All right, so this is what we do. We play with this equation. We estimate that beta I is around 0.9, and we estimate the average convenience yield, the average lambda, to be around 2%. Okay, so that tells me something like world investors, on average, are willing to forego something like 2% in order to buy US Treasury bonds. But then there's a second thing, which is the thing in a way I find more interesting about this estimation. This beta I is around 0.9. Okay? All right, so.
Do you exploit that actually? Do you use the whole mean reversion of the x as well? Do you use the whole process of x?
We do a bunch of different things. If you're asking,
because the x is moving around and you know it's mean reverting quite a bit.
it is mean reverting. Yeah, yes. That's all. We estimate this whole equation. We do this a bunch of different ways, but yes, we use all of that data. And then we have, that should tell me if x goes up and mean reverts at a certain rate, then how much does the exchange rate move? And actually, Marcus, you're exactly right. That's in fact what allows us to pin down beta. Right? That's how we back beta out of the data. So here's what I find interesting about this exercise, and this is what connects up to public and private dollar assets. What this tells me, the fact that beta I is less than 1, and is actually not just less than 1, is a number like 0.9. And by the way, this construction, this estimate of beta, will depend on which asset you're swapping in. Right? I could do my beta I here is an average across G10 countries. So if I take a UK government bond, add the swap, I'm going to get a beta I. In principle, those betas could be different, and they are different when we vary the underlying asset. But they're actually not that different. They're all around a range of like 0.8, 0.7, 0.9. They are sort of in that range. That is to me, a very important fact, because it tells me that the thing that really matters is not the underlying asset. I needed some asset to back a forward. The thing that's really valued is the forward. And what is the forward? The forward is a promise of $1 against a sterling. And so what is really happening in the world is if I can make a promise of $1, that promise has a lot of value. Relative to another promise, because an FX forward is a promise of $1 against a sterling. Right? If those two promises, I promise you $1 for sure, I promise you 1 sterling for sure. If those two promises had exactly the same convenience value, then the FX forward sort of cancels out. The fact that what's happening here is that adding the FX forward to any foreign government bond shows up as a convenience value tells me that what's really happening is that the FX forward is valuable. So I walk away from that saying that any promise of dollars, and an FX forward is a really nice contract because it is exactly a promise of a sure dollar against a promise of a sure sterling. And so the relative value tells me which one is more valuable. So I interpret this data as telling me that the FX forward of a dollar promise is what's valuable. And now I can create FX forwards and attach them to different assets. And an FX forward is fundamentally, it's a bank promise. So a bank promise is quite valuable. The treasury promise is more valuable, right? The treasury promise is effectively the beta equals 1 security. The bank promise, I'm just telling you here, is the beta of 0.9 security. So what I read from this data is that promises of $1 contain a lot of value to world investors. A promise of the surest $1, which is a treasury bill promise, has the highest value. But a bank promise actually has quite a lot of value. So it's not about treasuries per se. The regressions, the co-movement I'm showing you wasn't about treasuries. It was about flows in and out and demand attached themselves to safe dollar assets. That's really the way I understand that world. Yeah.
The counterparty credit risk is part of that.
It's part, yeah, so this is like, if I look at commercial paper, P1 commercial paper, it has a lower convenience yield than treasuries. Why? Sort of treasuries are like the par excellence of the safe liquid asset, commercial paper a little bit worse. So I think of the swapped.
Is there a way to take the counterparty credit risk out?
I think that's the reason why beta is 0.9. Or I'm not sure I understand what if I may not be answering your question exactly.
I thought you labeled this as convenience yield.
It's a convenience yield attached to a security that's not quite as good. You're saying, can I hedge out the counterparty credit risk? Yeah, so one could imagine if JP Morgan writes the contract, can I take the JP Morgan forward, add a CDS contract on it to hedge that out, and then wouldn't that be equal to the T-bill? I'd say yes, but I'd say for the same reasons why the beauty of safe debt is you don't need to know anything. Turns out if you package UK government bonds with an FX forward, with a JP Morgan CDS, well, you need to know a bunch of stuff, right? The lovely thing about the T-bill is it's already taken care of for you. So that's the sense in which it's good, but it's not quite as good. Maybe, if one puts investors on some line and start with the investor who is willing to know a little bit of stuff, he'll buy the.
Because I don't have to think about all these things. What counterparty credit risk is a risk.
It's a risk, exactly. So it's not as good. In the same sense, P1 commercial paper, not as good as T-bills. Why? Because it turns out you need to know about Ford. Yeah, we've set the face value so that you mainly don't need to know about Ford, but you still may need to know about Ford, have to know about Ford, right? So the world can't generate safety in all states ever, where the world is always some compromise of generating enough safety, and so this is that. And so what's happening in the world is we're potentially taking many assets, backing them, putting on forwards, and we're creating dollar assets. That's the asset that's really valuable, as I read in the world. So the picture, the correlation between treasury basis and exchange rates, it's not about treasuries. It's about the demand for dollars, right? If I could have constructed another basis that didn't involve treasuries, I would have found the same result. It's the safe dollar promise that particularly has a high value. Yeah.
Just to make sure I get the notation, its treasury basis is lambda times 1 minus beta or lambda times beta?
It's the difference between those two interest rates. So it's 1 minus beta times lambda.
1 minus beta, yeah. So it's like 2% times 1 minus 0.9. So that's like 0.2.
0.2, yeah. The treasury basis is on average about 20 basis points. And so since beta is 0.9, that's the 2% I'm coming out with.
And lambda is like the difference between like a euro bond and a treasury bond.
On a swap basis.
On a swap basis.
Sorry, that's not lambda. Lambda is the way to think about lambda is an uncovered interest parity relation. I am thinking in a completely uncovered way. I could buy UK government bonds or I could buy US government bonds. Right. And I value the exchange rate risk. I want a dollar promise, right? So for that, I need to play with UIP. Right. I mean, this also answers, Mark, your question. The asset that's really valued in the world is a sure promise to pay you $1, right? When you take the foreign government bond and swap it into dollars, you've thrown away, you've created another type of sure promise to pay $1. The thing that's really valuable is the thing that is the dollar promise. And the UIP relation tells you that. It tells you something about the relative value of the sure dollar promise versus the sure sterling promise.
It's like deviations from frictionless pricing, lambda, right?
I mean, I gave you a model yesterday which gave you a motive for a convenience yield, right? So there's a transaction motive for liquid safe assets. That's what lambda is. For this equation, I have nothing to say about where lambda comes from, but I can measure it by constructing the spreads, and so then I can learn something. All right. If you ask me what the deep model of lambda is, I'm going to say look at the analysis I did yesterday.
Yeah. Question that the beta has to be the credit risk.
The beta is a reflection of the credit. I want to say it's not the credit risk, it's the I don't know risk.
Okay, but it could just be something like what you had yesterday. Like in the event you have to liquidate the pound asset earlier, maybe the treasury market is thicker.
Yeah.
It could be something like that.
Absolutely.
Okay.
It could be something like that. Yep. This other asset is the thing that takes care of me in all cases, right? But when you say I can't liquidate it, it must mean that someone else is not willing to buy it, and this is why I'm leaning on the information sensitivity. For me, that's like a leading reason why the asset becomes illiquid.
I mean, yesterday you had this thick market thing. You could think in those terms as well. No?
I think that's totally reasonable. Yeah, and that is what's happening, right? My security here, the foreign government bond swapped into dollars, is creating a dollar asset. And in the model I wrote down yesterday, the government asset and the private asset were perfect substitutes. I need a little more wedge in there to make sense of this type of spread.
There could be an interim where before the forward you may want to
Something.
do it early.
That's entirely possible. Yeah.
I thought I understood what you're doing, but now I look at this, maybe I don't. X is just the value of holding a dollar. But
Lambda is the value of holding a dollar relative to the.
X, okay, in the plot, X seemed to be always one sign.
Yes.
But then we're summing an infinite number of these things. Doesn't it blow up or something? I was just literally looking at that infinite sum.
This equation.
The next one, where's the one with the X?
Mm-hmm.
Yeah.
Mm-hmm.
So X, how do we know that this sum converges? It seems like it's always just blowing up, no?
Mm-hmm. Yeah, I think you need some interest rate differential here to also, that's a restriction in this equation.
I see.
So actually another way of interpreting the world is that for this to make sense, U.S. interest rates on average need to be lower. U.S. real interest rates need to be lower. That's another thing that comes out of.
No, I see.
Right. I'm not using that for what I'm saying, but that's in a sense that's the.
I really just wanted to understand the.
Yeah.
X always seemed to be one side.
X looks basically one-sided.
Yeah.
I think that's exactly right. But yeah, I think another way of reading this is. And that's sort of consistent with this idea, this global imbalances, low R. Yeah. Yeah. Okay. And just to relate this to what I said was talking about yesterday, I think the theory I went through yesterday was that treasuries cause dollars, if you understand what I mean, right? It was we have safe treasuries that have then convenience yield, and they're used, and then private dollar assets also have the same properties. So for this regression equation, I can't really say anything about why the world is the way it is. But that theory, to me, tells me that treasuries cause the dollar rather than the other way around. OK. I hope that was all clear. Let me just sort of sketch through some arguments. This is another paper I have with Hanu and Zheng, because I find that, to me, these 2 points, which is dollars are very safe, and carry extra value relative to any other asset in the world, and that it's asymmetric and it goes up. But sometimes I find like that's a nice way of understanding the whole international financial system. So I'm just sort of going to talk through a model, but I hope the economics are clear. Take this convenience yield facts that I put on the table. Assume one more thing, which is that U.S. entities can produce safe dollar claims more cheaply than the rest of the world. Okay, why more cheaply? Say they have revenue streams in dollars. So from a corporate finance standpoint, it's easier to produce these things for U.S. entities than the rest of the world. Okay. What will you see in the world? First of all, the fact that there's a convenience yield will mean that everyone in the world will try to get in on the action, producing dollar claims. In a way, that came out of the paper yesterday, and that is certainly the world, right, that we see. The fact that the U.S. entities can produce this more cheaply than the rest of the world immediately implies that you'll get the levered gross asset position of Grinch Andre. The U.S., you could almost think of these convenience assets as a good that the world values. The U.S. can produce them more cheaply. The U.S. should sort of produce them and export them, right? And that fits very well with these narratives about global imbalances and the crisis. The rest of the world wants these convenience assets, and that's growing in the pre-2008 period, and that's why you can understand why U.S. financial sector leverage went up and why that ends up being a risk factor for the financial crisis. The rest of the world will get in on the action, produce dollar assets. Of course, the rest of the world doing this is doing it at some risk. The Brazilian firm that's issuing dollar assets is doing it because it has convenience value, but at the end of the day, it's also taking some currency mismatch risk when it's doing this. Now, there's a huge literature in international about why do firms in emerging markets borrow in dollars. It starts with this original sin question, and it's grown from there. Let me just say and just point this out, which is that the thing that happens in the world is the firms borrow in dollars. Most of that literature is about why firms don't borrow in their local currency. To explain why, when you don't borrow in your local currency, you choose to borrow in dollars rather than Swiss francs or yen, you need a theory of why, when you don't borrow local, you end up in dollars. You need a theory like this that says that it's these things that are particularly valued, and so that's what the world does. It's creating the stuff. And then a third point. This is just the trade point. Gopinath and Stein make a very similar point, which is if currency mismatch is costly and you can restructure the way you invoice trade to reduce that cost, then you will want to. If the rest of the world is borrowing dollars, you're running asset liability mismatch, and then so it follows that you would want to do this. You would want to also invoice in dollars, which is another fact about the way the world is set up. All right, let's do a couple more things. This is that exchange rate expression I wrote down, and let me now posit that the convenience yield is some decreasing function of the quantity of US dollar assets and foreign produced dollar assets, which is analogous to some of the empirics I showed you. So what will that mean? Well, this gives me a kind of a way of thinking about the fact that two things happen in recessions. The dollar appreciates, or in a global financial crisis, and treasury yields fall. Convenience yields rise. Why? Because you can think about, say, the GFC as a decrease in Q and Q star. Previously safe assets were no longer safe. That's decreasing the net supply of safe assets. What would you expect then to see is you'd expect these convenience yields to rise. Then if these convenience yields rise, you would expect the dollar to appreciate. So you would expect to see a very close connection between shocks that decrease Q and Q star. And I can think of a whole series of shocks which sure look in the world like is what correlates with dollar appreciation. There's lots of work that shows that VIX, for example, is very correlated with dollar appreciation. The way I read that is effectively meaning that the quantity of safe assets is decreasing. So decreases in quantities should get you increases in convenience yields, and so that you get this natural thing that happens in the world. And then you can then think about spillovers. The rest of the world is producing dollars with currency mismatch. If you then recognize currency mismatch plus any form of credit constraint, a dollar appreciation will worsen firms that are producing dollars, which means they produce less dollars, which is really an amplifier. So an exchange rate dollar appreciation reinforces these spillovers. Firms around the world now are in more dire straits. It's one of the reasons why one of the things that's very clear in the data is that dollar appreciation is correlated with bad world outcomes. It follows very naturally from recognizing that the rest of the world wants to get into this action of producing safe dollars. And then I can say the same thing in terms of US monetary policy. If you think of tightening of US monetary policy, that in the end is contracting borrowing, which is reducing the supply of dollar safe assets domestically. I can also think about changes in QE as changing the supply of dollar safe assets. You would immediately expect that these things would change convenience yields and move exchange rates, which they do very strongly. There's a very strong relation between QE actions and exchange rate movements will follow very naturally. There's also, Alain Ray has these fairly influential papers that argue that there's this global cycle and US monetary policy plays a big role in it. It would follow very naturally from what I've just talked you through. And And then because dollar convenience yields are special in the world, things like expansion of dollar swap lines, increases in Q, would expect to affect exchange rate, which they do very strongly in the data. So, and then the last thing that I would say from this paper is that one of the things that we see in the world is in bad states of the world, like a crisis, the dollar appreciates. And the dollar also, the US also has this leveraged net foreign asset position. So that actually poses a little bit of a question, which is if the US is on net levered and short safe assets, then bad times, you would think, would transfer wealth to the rest of the world. And then under standard international preferences, if you're transferring wealth to the rest of the world, that should cause a dollar depreciation rather than dollar appreciation. I think this convenience yield story gives us a nice way of resolving this. And the nice way of resolving this is that if in a crisis what people really value are US convenience assets, and the US is the privileged provider of convenience assets, it's like the rest of the world wants gold and the US owns the gold mine. The gold mine is more valuable in bad states of the world. That's actually would lead to a net wealth transfer back to the US because they have the asset that the rest of the world wants. This way of thinking about the world actually helps to resolve this question about how to clear the goods market with exchange rates. Here's a picture around the 2008 financial crisis of total wealth of the US and the rest of the world. And the rest of the world's wealth portfolio really falls a lot. The US's wealth portfolio falls, but not quite as much. I'm going to interpret this gap as reflecting some of this value of convenience that the US is producing. Okay. Let me just, I'm running out of time. I had some more stuff I would talk about, but I'm not going to talk about it. Let me just end with this and say one thing, which is that what's interesting to me about looking at the world through the lens of these safe assets and dollars, we used to be in a system in which the dollar was de jure the center of the world, the Bretton Woods system. We live in a world in which it looks like that's true, but it's true organically. And that begs questions. Why is the world settled on something that looks almost, we don't have fixed exchange rate systems, but we sure have a bunch of things that look like the world is fixed to the dollar. To me, one way of understanding this is to recognize that dollars are global money. And then then that collects a bunch of things together. So I was going to use this to talk about Bretton Woods, but I'm not going to do that. Let me just stop here. I think what I've tried to talk through is that public debt and private debt are really money, and understanding that helps us understand a bunch of stuff in macro and finance. So thank you very much.